Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. Last time, I taught you everything you need to know about accounting. I taught you about the balance sheet, the income statement, and the cash flow statement. And we also saw how these ones are interconnected and the effects it will have by changing one or the other, and this would be reflected in the balance sheet. But the hard thing about accounting is not really understanding the concepts. That's only the first step. The hard thing now will be classifying each and every one of the expenses of transactions or even movements of money within the company, because this will have specific names in accounting and it will also fit only in specific categories. So, for knowing how to classify all of these things, I have a simple model that's going to include basically 7 boxes in our heads. So we're going to have one small box for cash, because usually most transactions will involve a cash move. Then we can think of other non-cash assets, and this will add up a lot of things because it can be inventory, it can be property, plant, and equipment, it can be, accounts receivable, but all of this will have it in another non-cash asset little thing, and these 2 boxes are going to add up all our assets in our heads now, because I was showing you in the statements this looks different, but first I'm going to simplify it for another model in your head. So we'll only have cash and non-cash assets that will be representing the entire assets. For liabilities, we'll only have one thing that's called liabilities, because their current liabilities or non-current liabilities are not going to be as important, just we have to know if we have an obligation or not, and this will fit in a little box called liabilities. But the box that we're going to expand a lot, it's going to be equity. In equity, we're going to expand it first in a little box that's going to be called contributed capital, because contributed capital is going to be the stocks or the shares outstanding of a company. But to that, you're going to add the retained earnings. And I've mentioned this concept in all of my accounting episodes. Retained earnings are going to be the retained earnings from the previous time plus the net income. And net income, we can summarize it as revenue minus expenses. And then we're going to take dividends away from that. So here I just mentioned the 3 boxes that I was going to add: revenue, expenses, and dividends. And so for all of this, what I'm going to have, it's a big formula. And I'm going to put a photo of this formula that I'm talking about in the podcast so you can see it while I'm talking. But we're going to have cash plus non-cash assets. It's going to equal liabilities plus contributed capital plus revenue minus expenses and minus dividends. So what did I just do? I had my balancing equation, assets equals liabilities plus equity, but equity, I divided it into retained earnings and specifically into also the net income. So I opened up all of the boxes. And so why do I have this horrible equation that I'm showing to you right now? Because as I was telling you in my first episode, everything that you're going to do within a company will affect 2 financial elements. We're going to see which ones, but what you need is to see all the possible elements, because you'll need to balance them out. If you pay for inventory, you can't just write it simply, oh, I paid, I now have negative $100 in cash. It won't work that way. You always have to balance it. So if you wrote it somewhere, you have to balance it somewhere else. If you wrote it in liabilities It may be have to balance in equity or in assets. And this is how we're going to start playing with all of the 7 values that I just told you, because basically we can summarize the most of our transactions within the 7 columns, and we will also balance them out in the 7 columns. So for today, I brought specific examples that we can think of in how we would reflect these ones in all of these elements. So let's take first an example that's going to show a debt or a loan. So let's say I acquire a loan for $15,000 and I'll have to pay interests monthly for 2 years, and then at the end of those 2 years, I'll have to repay the principal amount, so the $15,000 again. How would I classify this on the balance sheet? And so first, before you start thinking of how to move all the elements, the most important question you have to make yourself is when. When are we going to do this? Because depending on when you are writing it, it will change the entire thing. So let's assume in September 1st, I received the money. So because I received the money, I'll have a positive $15,000 in cash now. I have more money. But what changed? How can I balance this out? Well, basically, it's going to be in the liabilities part, because now I have $15,000 of liabilities, but this one, because it's money that I owe, it's going to be negative. So here we'll balance it out because it's positive and positive, because I have now an amount of money in cash, but I also have an amount of liability, even though I know mentally that this money will be an outflow in the future. But now let's say we reach up to September 30th. I have to pay interests the day after that, the interest for my first month. So now I have a new liability. I have the liability of the interests, and because we can't balance this out somewhere, I haven't paid it, it's not an asset, what we're going to do is that we're going to balance what can't be balanced basically in the equity. So equity is sometimes called the residual, and this will also make sense for us when we have to balance things out. We always have to start with the assets, then with the liabilities, and if it's not any of those, we'll have to move the equity either up or down because we'll be balancing it out. So I added a new liability, which would be the interests. And this one, we'll put it as an expense, let's say, also for the amount of the interest. But now, let's move the dates another bit more. Let's imagine it's now October 1st. I have to pay those interests. So I'm going to take that money from the liability. I don't have a liability anymore, but I'm going to also take it out of my pocket. This will mean I'll have the negative value of the interests on the cash part. And how this is going to be reflected is how we had it as an expense, because now it is actually an expense because I paid for that interest, but it wasn't a liability now because I don't owe it anymore. It was just an expense. So as you can see, loans can be written in 3 ways. What we have to think of is when are we balancing out everything, or when are we assigning all of those values. Another thing that we could think of, for example, would be when we're buying property, plant, and equipment. So let's say I'm purchasing an entire factory and I paid $1 million for it. So that was a cash outflow. I paid $1 million. Where do I balance it out? Basically, because it was a factory, it will be an asset that I have. A long-term asset that will classify then as property, plants, and equipment. But if we're just thinking about the simplified boxes in our heads, it would belong to the non-cash assets. So I pay $1 million, but I also add $1 million in my assets. So when we add that, it will be balanced out, 0. if you start getting the logic to it, you'll start seeing it's very simple. There are just small cases where you won't be knowing exactly when to put it because it will vary in time. And I'll bring another one of those tricky things when we're thinking about the change of time. First of all, let's imagine I'm paying Google ads. And so I paid $1,000 in ads, but I still haven't seen the ads published. So how can I write that on the first day? If I still don't have the product, Google is owning me, those ads. What do? I already had my expense, so what we're going to do to balance it out is that we're going to add an asset called prepaid ads. And for this one, it's going to be as if we had a prepaid asset. We already paid for this ads. This is going to act as an asset for us. We can't say we have the ads yet, but what we have is the prepayment for it. If they decided not to do it, they should give us the money back and it would be fine. But after they do it, we have to take the money away from that prepaid asset because we don't have it anymore prepaid. We actually got the product. And so how we're going to balance it out now, it's going to be on the expense box. So in this second part in time, after they already delivered the product, it's going to be an operating expense. So maybe you start noticing these patterns. How are they moving in time? And my first rule of thumb is basically, if you say something is an expense, it means that thing is not an asset. And why am I saying this? Because this is just the example that we saw. When it's an asset, we can't balance it out as an expense. Or when we balance it out as an expense, we're saying already we don't have any control over their thing or that it won't bring any future inflow to us. It's an expense. So when you're thinking about how to balance the cash, you have to either think, is this thing an asset? Yes or no? Is it a liability? Yes or no? And then if you don't get any of those options, the most likely option is going to be that you'll balance it out with the retained earnings. That means either in revenue or in the expenses part. So one of my friends did this generalization, which I believe is very accurate. And so if this is an expense, it means that we had a cash outflow. If we earned that money, it's going to be called a revenue. If it's something that you have to pay to someone, we're going to add it in the liabilities, but we'll say it's a payable. If it's something that someone else owes you, it's going to be called receivable. If it's something that you paid for in advance, you're going to add prepaid to that thing, just with my example of the prepaid ads. And when it's a revenue or an expense, you have to know that you'll have to impact the retained earnings. This was her hack for knowing how to label all of the movements that we've been doing. But now I'm going to finish my episode with another tricky thing, and it's going to be when we're talking about depreciation. So depreciation is going to be a little bit more complicated because let's say I bought a product that costs $5,000 and I'm expecting it to work for the company for 5 years. But I want to see the value of that product after year 1. So what am I going to do? I'm going to decrease the value of the equipment in the non-cash assets. I'm going to take a little bit of value away. And how much do I take? Basically, I take the entire value of the product and I'll divide it by the years that I want to use it. So my product was worth $5,000 and I'll use it for 5 years. So 5,000 divided 5 will be 1,000. I have to take 1,000 away from that value. Because what happened, I already used the product for 1 year. So I already technically took the value of it for 1 year. And where are we going to match this? in the expense part. So even though this wasn't affecting cash, it appears in the expenses, and it will be called depreciation over there, and it's going to be the same amount, $1,000. As you can see, all of these exercises for balancing out are going to be a little tricky. So what you can do is think of all the possibilities that you can do. So how to assign values with property, plant, and equipment, how to assign values with inventory that you paid for in advance, or inventory that you gave in advance but you haven't received the payment. How to assign values, for example, with wages, or how do you do it with sales of inventory, for sales when they're done in credit, for even subscription plans which are done in advance, or for receivables, which are going to be those things that you're going to receive later. All of this is going to be extremely important for managing your accounting statements and knowing if they are properly classified. If you try practicing one of these exercises and you have doubts, leave it on the comments and we'll solve it together.